Krishna Dubey hereby welcome you to the event by thanking His Majesty Sultan Haitham bin Tariq, our sponsor CBFS, our corporate team in Sohar, Mr. Avinash Patodia for his support all the time for hosting Sohar team in his facilities. I hereby request you all to please stand up for ICAI motto song.
य एष सुप्तेषु जाग्रति य एष सुप्तेषु जाग्रति कामं 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 कामुषो पुरुषो निर्विमाणः निर्विमाणः तदेव शुक्रं तद्ब्रह्मा तदेवामृतमुच्यते तस्मिन् लोकः शिवः सर्वे तदूनात्यपि कश्चन एतद्वैत 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 एतद्वैत.
Thank you very much. May I please request our chairman, Mr. Sajeev Surendran, to please address the gathering. Thank you.
Dear members of Muscat Chapter of ICAI, members from Sohar Subcommittee, Managing Committee members, CA Harikishan Rankawat, Vice Chairman Dubai Chapter, a warm welcome to the CP event on UAE Corporate Tax Session. As you know, as we're all aware, from 1st June 2023 onwards, UAE is introducing corporate taxation based on the applicability of the residents. The accounting period is the relevance, so which probably Harikishan ji will explain. Considering the business connection of Oman entities with UAE and the professional front, the interest of chartered accountants in neighboring country, we thought this is going to be a relevant session for the members. With that importance, we thought of introducing or having this session today. Thank you for joining for this evening. Hope this will be a value addition to the members, and based on the developments in the law, the implementation in UAE, probably we may come up with another session after a few weeks or a month. We have to just see. Thank you so much for joining. CA Harikishan Rankawat, I wish you a very pleasant evening or a value addition session I wish to the members of the chapter. Thank you so much.
Thank you very much, CA Sajeev. Now may I please request CA Badri to please introduce the speaker.
Good evening, ladies and gentlemen. It's my privilege and honor to introduce the speaker of this evening, CA Harikishan Rankawat. CA Harikishan Rankawat is a fellow chartered accountant from India and a certified public accountant CPA from USA. He is engaged in audit, tax practice, compliance, and advisory services in GCC. He has 26 years of diversified experience in various roles during his career. He is the partner and CEO of RNG Auditors. RNG Auditors are proud alliance member of BOKS International, which is a top 14 global alliance of export firms. Mr. Rankawat is a senior partner with FinPro Consultancy Dubai, providing consultancy and tax advice services. RNG and FinPro are associate firms in UAE. Currently, he is serving as Vice Chairperson of the Institute of Chartered Accountants of India, the ICAI Dubai chapter, and serving as trustee of the Rajasthan Business and Professional Group in Dubai, UAE. He is a regular speaker at various forums on tax and finance related areas. He has written various articles in Khalij Times newspaper and were also interviewed by many times by Radio FM Dubai. With this brief introduction, I hand over the session to Mr. Harikishan. Thank you.
Hi, good evening, guys. First of all, I would like to thank Mr. Sajeev and the Executive Committee of the ICAI Muscat Chapter for inviting me to speak on the UAE Corporate Tax Law. I think you guys are also traveling to Dubai very frequently. Can you tell me what was the special on 9th of September 2009, 090909? What was the special in Dubai? I think I will let you know. I mean, actually, Dubai Metro was launched on 9th of September 2009. And UAE Corporate Tax Law was also launched on 9th of December 2022. And then they have come up with a corporate tax rate of 9%. And thereafter, like after the end of your financial year, you have 9 months to submit your corporate tax return. So number 9 is very lucky for all of us. And as a consultant, and a lot of consultants are working in Dubai, UAE as such. So everybody will have a lot of things, and tax compliance, definitely there is a better opportunity for all the practicing chartered accountants as well as newcomers in the country, because there is an acute shortage of IT professionals in UAE for sure. Now, I will start my presentation. So we will go through the background of the UAE corporate tax. Then we will look at the applicability, the basis of taxation, like we will understand the residential status, resident, non-resident. Then we will go through the calculation of corporate tax and applicable rates. Then free zone person. Free zone is very interesting. I mean, the issue is still we are waiting for the cabinet decision to be released in the coming days. But as of now, whatever we have, we will share with you. And I apologize because there will be a lot of questions which may not be answered at this point in time because we have to wait for the cabinet decision. They will clarify it further. There are a lot many ambiguities which will be definitely clarified by way of cabinet decisions from the Federal Tax Authority. Then we will discuss on the deductions. As you guys are already aware of the corporate tax in Oman, it is already there. So you guys are knowing better than me, rather deductible expenditures, non-deductible expenditures. But definitely I will touch upon every single article of deductions, Chapter 9. Then calculation of corporate tax liability also will go through. Then we will look at the related parties and connected persons. Maybe I can come this side if you guys are okay. Yeah. So related party and connected person will go through, and when it comes to related party, then transfer pricing documentation is a must, and we have to follow exactly the guidelines issued by OECD. That same model tax convention, will be applicable in this case. Then set off and transfer of loss. Yes, we can actually create tax groups, and then we can also set off the losses. And even if we don't form the tax group, if we have the common shareholding in various companies, then also we can set off the tax loss between these entities under the same group or under the same individual as well. Then withholding tax, the good news is withholding tax is 0% in UAE. As of now, they have put it 0%, but at a later date, definitely they might increase. And we will discuss on the administration part of it. When the registration is due, when the corporate tax payment is due, and when the corporate tax return has to be filed. Okay. Now, as you guys are aware, corporate tax is a form of direct tax, and indirect tax VAT was implemented on 1st of Jan 2018, and the corporate tax will be applicable from 1st of June this year itself for those companies like if they are having their financial year starting from 1st of June till 31st of May, then on the very next day, 1st June 2023, corporate tax will be applicable. And if the financial year is starting from 1st of July till 30th June, then 1st of July, and so on. So generally, most of the companies are having their financial year starting from 1st of Jan till 31st of December or April to March. For them, it will be applicable from 1st of Jan 2024 and 1st of April respectively in 2024. So always you just go on the next day, it will be applicable accordingly. I think most of the Australian companies, they are having their financial year from July to June. So for them, it will be applicable right from 1st of June. And Federal Decree Law number 47 of 2022 was issued on 9th of December, as I mentioned. And then tax period will be for 12 months. Okay, now let's have a look at the residential status. This is very, very important because we need to understand the applicability basis of taxation, which is the residential status. And when we talk about the residential status, definitely we have to look at the various treaties signed between the two countries. And there are like more than 100 treaties UAE has already signed. So we need to look at those as well in order to arrive at this residential status, whether it is resident or non-resident. So let's look at it. Resident, in case of resident, the worldwide income will be taxable in UAE, whether it is being generated or derived in UAE or outside UAE. Everything will be taxable in UAE. Now let's look at the further classification. The first one is legal person incorporated in UAE. Legal person, whichever companies are registered in UAE, whether it is in the mainland or free zones, all the companies will be liable for the tax on their worldwide income inside UAE and outside UAE as well. Then further legal person you can divide in two parts, mainland. If it is mainland, then 9% corporate tax will be applicable. And if it is free zone, then it will be 0%. Then foreign company. If foreign company is having their permanent establishment in UAE, then it will be 9% tax. Whatever income they are generating from the UAE. Okay. And permanent establishment, I think you guys are aware of the definition, but I just give you the background. In the definition of the permanent establishment in UAE, if you are having any fixed place of business in the UAE, or you are having even temporary or office working from home as well, then that will be considered as permanent establishment. Okay. And in one of the case like dependent agent test, whereby if somebody is really representing himself as the agent of some principal, then also, and he is signing the contracts on behalf of the principal very naturally, or it's kind of like it's his habits to represent the principal, then in that case, although, I mean, he is not having any sort of implied or explicit, identity, then also he will be considered as a dependent agent, and foreign company will have their permanent establishment in UAE, and it will be taxable in UAE. Natural person or unincorporated partnership. Natural person like you and me, all are individual persons, natural persons. If they are doing any business, and like I just give you an example, if I am having 2-3 real estate properties, whether it is commercial or residential, then okay, it's not a kind of business. I've just invested more than one property, that's fine. But if you are having 20-30 properties and you are generating a lot of income, there might be some other examples as well. If you are involved in any sort of business, although you don't have a license, and in UAE, particularly in Dubai, I've seen a lot of people, individual people, they are getting millions of dirhams in the bank account by way of these kind of businesses. So then those all natural persons will be part of the UAE corporate tax law. And then unincorporated partnership. The definition of unincorporated partnership, as the name indicates, unincorporated. It is not incorporated. Like you and me, maybe we can enter into a kind of joint venture and do some business as unincorporated partnership, or maybe there are more than 2 different companies all together. They come together for a specific project or joint venture. Then that will be unincorporated partnership, and that will be taxable as resident in UAE. Then non-resident definition is very simple. Whoever is not a resident will be considered as non-resident. In case of resident, one thing actually now we have to take care that even in India, as an individual as well, I have to get tax residency certificate from Federal Tax Authority. Earlier, TRC, whether it is individual or company, TRC can be obtained from Federal Tax Authority at a given, like maybe 1,000 dirham or something. That is must. Even now in India, back home, all the income tax authorities, they are asking for the TRC, whether it is an individual or a company. So once you obtain a TRC, then it means you are a resident of UAE. That is the solid, document or evidence of your tax residency in UAE. So always for all the individuals or for companies, we must get a tax residency certificate, then automatically your residency is hence proved. Okay, one thing you have to take care, natural persons. Here I put natural person and then star. So if any natural person is generating income from outside UAE, then it will be taxable only when it relates to any sort of business activities carried out in the UAE. Otherwise, it will not be taxable. Now, non-resident, as I mentioned you, we have to see in case of non-resident whether they are having any permanent establishment in the UAE or not. If yes, then their UAE sourced income will be taxable at the rate of 9%. If they don't have any PE, then whatever payments we are making to non-resident entities, we have to ensure that we deduct, as of now, 0% withholding tax. I think in Oman, you guys have 10%. As of now, UAE is, we don't have to deduct any tax, but yes, it is 0% tax. And nexus is something which they haven't defined as of now in the UAE corporate tax law. So this nexus, I assume that nexus, I mean, it can be any sort of nexus, whether it is verbally or written, doesn't matter. If you are having any sort of nexus and if you are conducting any business activity in UAE, then that will be considered as nexus in the UAE and it will be chargeable at the rate of 9% flat rate. But nexus definition, they mentioned that by way of cabinet decision, they will clarify. Definition of UAE sourced income, it is very simple. If you are generating any sort of income from the resident person, or if you are generating any income or from UAE PE of a foreign company, if they are generating any, as I discussed already about the PE of foreign company, or if the income is derived from any activities or contracts performed in the UAE, or from any assets in the UAE, or from any rights like maybe patents or trademarks or copyright, those kind of stuff. If you are generating, then that will be considered as income sourced in the UAE, and whatever income is being sourced in the UAE, whether it is by a resident or non-resident, will be taxable in the UAE. Now, there are few exempt persons. These first 4 circle, if you see, these are all government entities, government controlled entities, and a person who is engaged in extractive activities or non-extractive activities. So all of these 4 business, actually, they are automatically exempted. They don't have to apply. But if they are doing any other business other than the extractive business or what their main objective is, if they are conducting any other business apart from their main core activity, then that will be taxable even in this case. Then qualifying public benefit entity, this is nothing but the charitable institutions. As of now, like I see in UAE, Emirates Crescent Society is there, then Khalifa Fund is there. There are few other funds with the Sheikh's name. So those all, they are public benefit entity, and if you are giving any sort of, donation to them, that is all exempt. Then the last three, if you look at it, it is public pension or social security fund or private pension or social security fund and qualifying investment fund and any juridical person in the UAE that is wholly owned and controlled by exempt person. If that is the subsidiary of any government entity, that will also be exempted. But yes, in this case, you have to submit an application to authority for exemption. It is not an automatic exemption. And for the public benefit entity, these entities are for the public benefit or social benefit, and their main objective is to help the society for various social causes. And their objective is not to earn any sort of return on investment. So those entities, yes, public benefit entity, I mean, it will be actually, there will be few cabinet decisions they will definitely issue, and they will dictate that these are the entities which are public benefit entity. Exempt income, dividend and other profit distribution, okay, received from a resident juridical person. So locally, whatever dividend or capital gain you are receiving from any company, that will be exempt, number one. Then number two, income of a foreign permanent establishment. Foreign permanent establishment, like take the scenario of Oman, whereby you have an entity and you have a public permanent establishment by way of branch or any other setup in the UAE. Then what will happen, because you guys are already having tax here, 15%, which is more than the 9% in UAE. In that case, I think you have to, you can opt for. If you opt for, then you don't have to pay the 9% there. You can always say that it is already been taxed in the Oman. Or otherwise, you can opt for it and then get that 9% credit in Oman. So you have two options. Either you take the input credit or you go for election for exemption. And the third one is, now we spoke about local juridical person. If you are receiving any dividend, that is exempt. If you are receiving any dividend or any other profit distribution from a foreign juridical person, then you have to see how much is your participating interest, how much is your shareholding. If it is more than 5%, then that dividend and other profit distribution will be exempt. If it is less than 5%, then it will be taxable. And you have to ensure that participating interest you continue to hold at least 12 months. Otherwise, again, it will be taxable. And the fourth one is income derived by a non-resident person from operating aircraft or ships in international transportation. And any other income, capital gain, same thing, from a participating interest from a foreign jurisdiction. If you are getting, then again 5% your ownership interest must be there in that foreign entity. Foreign branch taxability, I already discussed with you that there are two methods. Either you go for credit method, whereby you can include the income of foreign branch in taxable income and then claim foreign tax credit in Oman, or otherwise you can go for exemption method, whereby you just actually elect for exemption. Once you elect, then you are a kind of, separate entity, and you don't have to pay any taxes over there, and in Oman you pay the taxes. Then you will not be eligible to claim the input credit. Now, if you are in the mainland, then the flat rate 9% will be charged on the taxable income exceeding 375,000 dirhams. And if you are in the free zone, then it will be 0%. But In the free zone, you need to ensure that you are a qualifying free zone person. And then in the free zone, they have defined further qualifying income as well as non-qualifying income. So qualifying income will be taxed at 0% and non-qualifying income will be taxed at 9%. This is how it is. But as of now, as of now, they have not clarified. We are waiting for the public cabinet decision. So we have to wait for that one. And then definition will be given in that cabinet decision at a later date. Now take the example here, accounting year. If it is like July to June, then your corporate tax will be effective from 1st of July 2023. If it is Jan to December, then 1st of Jan 2024. If it is April to March, then just next day, 1st April 2024 and henceforth. So they have spread over actually, if you look at, then registration, submission of the corporate tax return, they have spread over and their burden is also less and even our burden as a consultant is also less. It is kind of like VAT they have done. Now free zones, in order to become the qualifying free zone, you have to ensure these 4 conditions. Number 1, you have to maintain adequate substance in the UAE. What is happening, if you look at in UAE, there are more than 60 free zones. And there are companies who are not having any office. They are having just bank account and the company, no employee, nothing, and they are making millions out of this. So now all those companies, they have to create an economic substance in the country. And in UAE, we have economic substance regulation whereby they have defined that you need to have an office. It may be a flexi desk, but you must have an office. You must have employees, which, number of employees, I can't tell you. You may be generating, with 1 employee, you can generate 10 million, or with 10 million, maybe you might have 100 employees. It depends on the nature of your business. And then you must be incurring operating expenditures in the country. Then only you will be able to prove that you are having adequate substance in the UAE. Then definitely, if you are having any related party transaction, then transfer pricing rules will come into picture. You need to have proper documentation. That is the second condition. And the third one is you are deriving only qualifying income, which will be specified in the cabinet decision shortly. And you have not elected for corporate tax at the rate of 9%. As I mentioned earlier, that you can elect, or if you are elected for that 9%, then you have to pay. Otherwise, you will be, then only you will be able to get this qualifying free zone person status. These 4 conditions you have to ensure. And one good thing about, actually in Ministry of Finance, they organized one tax awareness session, and they mentioned that there are about maybe 656,000 companies in the UAE. And every single company, whether they are based in the mainland or in the free zone, they have to register with the Federal Tax Authority for the corporate tax. They have to file their corporate tax return, even if it is like 0% in the free zone, or you are having your taxable income less than 375,000, or you are having 0 income, or you are having loss. Everyone has to submit. So the compliance is like 100% mandatorily for each and every company, whether it is small or large. Doesn't matter, there is no threshold for that. That's the reason I am looking very happy. Okay. Now, Chapter 9, deductions. There are 6 articles under this, from Article 28 till 33. And in that they have defined what is deductible, what is non-deductible. But I feel that in Oman, they have already given like various thresholds for various deductible expenditures. But in UAE, we have to wait and watch for the cabinet decision. In the law, yes, for few expenditures, they have already given the threshold, but exact threshold for various expenditures will be coming up by way of cabinet decision. Now, deductible expenditure, the thing is very, the expenditure will be deductible only when it is wholly and exclusively incurred for the business, it is not in the personal nature, or it is not in the capital nature. So now, if there is any expenditure which is incurred for business and other purposes, maybe for personal. So if you are incurring for business as well as personal, then you have to identify business expenditure is anyway 100% allowed. A personal expenditure, now you are not able to identify out of this personal expenditure how much is the business and how much is the personal. So you need to arrive at some sort of cost allocation driver and identify how much is pertaining to business. And you have to have proper documentation and substantiate at the time of audit. And the non-deductible expenditure, if it is not for business, not allowed. Expenditure for exempt income. If you are incurring any sort of expenditure for generating like exempt income, dividend or capital gain, because income is not taxable, so deductible expenditure will also not be allowed. Then losses not related to business and any other expenditure which will be notified in the cabinet decision at a later date will not be allowed. Now I have taken few examples here. Accrued salaries and wages in the accounts are permitted as a corporate tax deduction or not. We have taken an example, and this example, I think it's very straightforward that this will be allowed. But like generally you have 9 months for submission of your corporate tax return, and still you haven't paid at the time of submission of your corporate tax return, then you don't have the intention to pay. Then you shouldn't be claiming that as deductible expenditure. Yes, sir, I forgot it now after 21 years in Dubai, but you still remember, that's very good. Okay, this is like if you have incurred any expenditure for repairing the asset and is not enhancing the economic life of the asset, then it will be allowed. If it is enhancing the asset's life, then definitely we have to capitalize and depreciate over the economic useful life of the asset. Number 3, yeah, if a debt is no longer recoverable, then whether this bad debt will be allowed as a deduction. Yes, it will be allowed, but we have to keep one thing in mind, because every company generally they are having their policy and they are creating some general allowances and specific allowances. They are creating 2 types of provisions. So it will be allowed only for a specific provision. If you identify that, okay, this is the Harikishan Rankawat, he is not going to pay for it, and then, I mean, further we are waiting for the further clarification. But if you identified that, okay, he has not paid and you have the policy in the company, specific debt, then yes, you can write it off at the time of bad debt. You will be allowed as a reduction, or maybe you will have to file a legal case as well. Like in case of VAT in UAE, at least you have to wait for 6 months. Still you didn't receive it, then you have to inform the customer that I am going to write it off. I mean, this is the law for VAT. Now, who will write, I mean, just for the 5% that I am going to write it off. So practically speaking, this is the issue. Now let's see for this scenario what will happen. We have to wait and watch. Interest expenditures, article number 29, they have defined here interest expenditure, and then under article 29 there are 2 articles, article 30 which is general interest deduction limitation rule, and article 31 which is specific interest deduction limitation rule. So let's look at now article 30. Net interest expenditure is kept up to 30% of EBITDA, adjusted EBITDA. I mean, adjusted EBITDA means from EBITDA you have to exclude the exempt income and then calculate 30%, that net interest expenditure will be allowed. And net interest expenditure is simple, I mean like interest expenditure minus interest income and plus whatever net interest expenditure which you couldn't claim in the prior year, that you can add here. And when you are doing this, you have to ensure that generally it is like you can carry forward for the next 10 years. So you have to use FIFO method in order to have proper tax planning. Otherwise, you will be losing because you have to always calculate 10 years. So use FIFO method in this case. And these provisions are not applicable on banks, insurance provider, and natural persons. They have already clarified in this article very clearly. This is one of the example that ABC Limited has generated an EBITDA of 800,000 for the calendar year 2022. Then tax officer has disallowed entertainment expenditure of 100,000 and bribes 100,000. ABC Limited has taken a loan of 86 million on 1st March 2022 towards working capital for its business. The rate of interest is 5%. ABC Limited has also received interest 50,000 and brought forward net interest expenditure from the year, just assume that it is applicable. I should have taken 23 and 24 rather than. So 23 was AD 150,000. Let's calculate net interest expenditure and all this adjusted EBITDA. So I'll just go to the next slide. Okay. So interest expenditure 250,000 for the current year, then brought forward net interest expenditure was 150,000 and taxable interest income is 50,000. So net interest expenditure is 350,000. Then EBITDA 800,000. You remember there were two actually bribes and penalties. They were disallowed, but I am not adding it here because in the law they mentioned very clearly EBITDA, accounting EBITDA, excluding exempt income. So I have not added back disallowed expenditures in this one, and I have taken only the reduce the exempt income, which is dividend income from UAE company. As I mentioned, you dividend income from domestic company will be an exempt one, and then dividend income from US company that will be exempt if you are having participating interest more than 5%. So in this case, it was more than 5%, so both are exempted. And you arrive at adjusted EBITDA of 600,000, and then you take 30% of this, 180,000. And brought forward, now total net interest expenditure we were having 350,000. So 350 minus 180. So 170,000 you can carry forward for the next 10 years. This is how they have explained. I hope in Oman how it is. Is it straightforward or? They have made it a little bit complicated, and I don't want to go in further nitty-gritty, but this is really one of the very debatable issue going on in the UAE now. Huh? Yeah. Then specific interest deduction limitation rule. This is very clear actually. If you are taking any loan from the related party, then by default interest on related party loan will not be deductible. Unless in the clause 2, you substantiate that I have taken this loan not for any corporate tax advantage. If you can prove, well, then it will be allowed. And the clause 3, they have mentioned that if you are taking that loan from a related party from a jurisdiction where the corporate tax rate is 9% or more than that, then it will be allowed. Like if I am an entity sitting in UAE and taken a loan from Oman company, then Oman already 15% tax they are already paying. In that case, it will be allowed. That's a good question, sir. Ultimately, I think you are linking back. So you have to look at the rationale, and definitely then it will be part of related party loan only, because you got the loan based on the guarantee provided by related party. Yeah. I mean, there will be definitely all these deductible and non-deductible expenditures everywhere worldwide. There are many cases. I have taken one example here. If you look at it now, the shareholder of ABC Limited UAE has taken a loan from his brother based in Bahrain to pay himself a 10% dividend. Because in Bahrain, it's already tax-free zone, so it will not be allowed. But if you flip the example further, and now shareholder of ABC Limited UAE has taken a loan from his brother based in US in the US already the corporate tax is more than 9%, then it will be allowed. Because now they see at the end of the day, they are looking at it has to be taxable somewhere, that you are not playing with the non-tax free zone, non-tax country and tax country. Entertainment expenditure is always a debatable issue worldwide, and they mentioned in the clause 1 that entertainment expenditure will be allowed up to 50% of actual expenditure, whatever you incurred. In clause 2, they mention that it has to be incurred either for customers, suppliers, or shareholders, or any other business partner. If you note down here, they didn't mention specifically employee. So now we are a little bit confused over there, and we don't know whether employee will be falling under business partner. Because nowadays, if you see, I mean, I don't know about here, in UAE at least I have seen in many companies, they are calling finance business partner, HR business partner. So whether that will be considered here in this other business partner or not, we have to wait and watch. Yeah, so let's see. Yes, sir. If they are having, I mean, there are very few startup in this region. If you look at it, even in UAE nowadays, yes, few companies might be falling under that. And entertainment expenditure, they have given the definition further: meals, accommodation, transportation, admission, and facilities and equipment. A few examples they have given further. Now, anyway, I have taken few examples whereby a meal with a client where work is discussed, then it is for business and it will be like 50%. If the meals and entertainment, if it is included in employee's compensation, like if in the labor contract it is included, whatever is included, then that will be 100%, and it is not falling under the entertainment expenditure. That's why it's 100% allowed. Then all other employees meal at a conference, employee meals while traveling, food for a board meeting, dinner provided for employee working late, 50%. I have assumed here that employee is also part of the business partner. That's what I have assumed. If it is not, then anyway it will be 100% allowed because they are sitting late for the business or whatever for finance. Then entertaining clients. If you have given concert tickets or golf tickets to your clients, customers, or to anyone, and that client is not accompanied by the employee, then that expenditure is not generally allowed worldwide. Next one is, if you pay for your client's night out, but you don't actually go with them, then it is 0%. So you have to go there. Yeah. Now Article 33 is for non-deductible expenditures. Article 33, they have divided in 3 parts. If you are giving anything like donations or to outside party or to qualifying fund, then it will be allowed. If it is not qualifying fund, then it will not be allowed. Then there are few internal giveaways, like whereby you are giving dividend or you are distributing profit to yourself, that will be disallowed. And the third one is internal, external, and government takeaways. If you are paying any sort of corporate taxes or recoverable VAT input to the government, that will not be allowed. So let's look at one by one. First, we look at external giveaways, donation, grant, or gift made to an entity. Then it will be disallowed. But if it is made to qualifying public benefit entity, it will be allowed. Fines, penalties, bribes, or other illicit payment, you are knowing that it is, you are violating the law of the land, then it will not be allowed. Take few examples, like I have considered here that Emirates Red Crescent Authority is a public benefit entity, I am assuming, so it is allowed. Okay. Another one is 50,000 as penalty was paid for late filing of returns, so that will not be allowed because it's a penalty. But please keep in mind that if it is compensation for damages or breach of contract, then that will be allowed. Penal interest is a penalty. At the end of the day, it will not be allowed. Breach of contract may be like in case of contracting companies. Generally, you are given a deadline that you have to finish the project by such and such date. Otherwise, there will be a penalty of 5%. So that is the breach of contract. That will be allowed because this is the nature of the business. And in this one now, this is very interesting actually. I have kept the animation. The solution, it was supposed to come later on, but at the last minute, I think it's got changed. So now you know the answer, but this is very interesting. A penalty was levied on a taxable person for purchasing goods for a specified purpose at a concessional custom duty of 1% instead of 4%. But he didn't utilize the goods for the purpose for which it was bought. The penalty or fine has been levied for breach of contract for utilization of goods other than the specified purpose. So generally when we see breach of contract, then we say, oh, it's allowed. But in this particular case, it is not allowed because you are violating the law of the land as well. The custom duty, again, governments, there is a law for the custom duty and all. So you violated the law, and that's the reason it's a non-compliance of the law, and it will not be allowed as a deduction. This one is very interesting. I mean, there was always a dispute whenever I presented in Dubai. Like XYZ Limited, a pharmaceutical company, provide free medical kits to the medical practitioners, doctors, amounting to AED 50,000 if they are able to meet their sales target. So whether this will be allowed as a deduction or not, I mean, my assumption, or rather there is a legal case in India and they said it is not allowed because doctors are not like employees of the pharmaceutical company in the first place. So they shouldn't have any sales target. This is all kind of bribing, so it will not be allowed. And there is a legal case in India for this one. Commission paid to your employees. Yeah, whatever you call it, at the end of the day, whether he can declare this one in his hospital that I'm prescribing this particular medicine and getting this commission or incentive. No, so it is not legal. Although everybody is doing in practice, but it won't be allowed. Now, internal giveaways, as I mentioned you, dividend profit distribution or drawings, if you are drawing from the business, then that will not be allowed. And we were actually wondering, few people were asking, yeah, I mean, this is anyway appropriation of the profit or drawings is personal. So why it will be allowed and why they are putting in the law? But in UAE and this region, you know that even people are not maintaining the basic accounting. I mean, I have seen a lot of big businesses, they are not maintaining any accounting. They see in the bank, okay, I'm getting the money and that's it. Salaries of honor, this is a very good question, sir. And there is a particular article 36 where they have defined connected persons. And in the connected person, they have mentioned officer, director, honors, and any other relative. Like till 4th degree, great grandfather, upside or downside, you can go, right and left, and even adopted kids. They put everyone in the connected person, which is not there worldwide, or even in the OECD guidelines, it is not there, but they have put it in UAE. So whatever salary you are paying, any unreasonable payment to any connected person or related party will be disallowed. Now you have to prove that this is reasonable. There is only one way. You need to have proper transfer pricing documentation containing 300, 400 pages, and you justify if it is reasonable based on the qualification, experience of that particular person, then yes, it is allowed. As of now, they haven't come with any threshold, and I believe in Oman you guys have some threshold here. So I hope, I mean, if, yeah, then 1500 Omani Riyal per month. Okay. So that kind of, maybe they might come up with the threshold. But as of now, as we read the article and the law, you need to have proper transfer pricing documentation. And in UAE, everybody is giving salary to themselves. So then there is a big room for all of us. Like for transfer pricing documentation is not an easy task, definitely. There will be a great opportunity for all the consultants. Yeah, so I have just put an example here. 10% dividend he is paying, PQR Limited is paying to its shareholder, so it will not be allowed as a deduction. Mr. P, a partner in Messrs. PQR and Associates. This is an unincorporated partnership firm in UAE, has withdrawn an amount of 50,000 from his business. So this is a drawing actually. In unincorporated partnership, there are two options actually. Either you general by default rule is in case of unincorporated partnership, all the partners will be taxable actually in their individual capacity. But if you want, another option is you can go to the Federal Tax Authority and apply for taxable, taxability on unincorporated partnership as well. That option is also available. Otherwise, by default, it will be like whatever taxable income you are allocating it to various partners, it will be taxable in their individual capacity. Now, this is the government takeaways I was mentioning under Article 33. So, corporate tax, then recoverable VAT input. So, if it is unrecoverable or irrecoverable VAT input, that will be actually going in your expenditure. And if that expenditure is for wholly and exclusively incurred for the business or profession, then that will be allowed. And any income tax imposed outside the state or any other expenditure as specified by the minister, all these will be non-deductible expenditures. Now you see this example, X paid 150,000 at VAT in respect of goods and services which are used for making taxable supply. So VAT, this is recoverable VAT, so it will be disallowed. Sir, this is your fault. You will not see. You did one mistake. You didn't claim the VAT input last year. Now you want to claim. If it was not allowed by the Federal Tax Authority, then you can claim it. Because that will, by default, what will happen in our accounting software or ERP, that will be part of your expenditure. Then if it is for business purpose, then you can claim if it was not recovered. But if you, by mistake, if you couldn't recover, then it is one mistake, and then again, second mistake, you are making it like less deduct, this is deductible, not allowed. Okay, so until now we understand this non-deductible expenditure as we discussed external, then internal, and government takeaways. These are all non-deductible expenditures. One example I have taken for the calculation of the taxable income, I think it is visible or no? So I put it here, income, revenue from sale of goods, 1,000, then dividend income from UAE company and US company. So both of them are definitely exempt. Gross revenue, then direct cost, then gross profit. And then the salaries and wages paid to unrelated parties, VAT penalty paid to FTA, golf tickets for various clients and suppliers, which is generally disallowed, and office rent paid to owner's wife, 2 million, but the arm's length price was 1.5 million. So 500,000 extra we have paid, which will be disallowed. And then total indirect cost and net profit. So let's have a look at it. Net profit during the year 207.5. Then you have to add non-deductible expenditures, penalties added back, entertainment expenses, golf ticket, let's add it back. Then office rent paid above arm's length, 500,000 again added back, and we arrived at gross revenue of 209. Then less exempt income, which we have to reduce anyway, because it's not taxable, so reduced, and then you arrive at gross taxable income. Now, of this gross taxable income, you have to take 75% because losses, any loss, that loss can be carried forward, and you can always claim up to 75% of the taxable income during the year. So you arrive at 148, and then finally you arrive at taxable income. So if you look at it, actually,
Yeah, brought forward loss was 200 million, but we have claimed only 148.9 only, because there is a limit. You can claim in the current year up to 75% of your taxable income. But one good thing is you can carry forward the losses for an indefinite period, which is a very welcoming decision for all the businesses. I mean, now related parties, connected person, I gave you little bit an idea. Related parties, as I mentioned you, any related party, they have covered related party up to fourth generation, great grandfather, and then adopted person and all they have included. And connected person, as I mentioned you, all the directors, owners, shareholders, they will be connected person. So if you are dealing with any of the connected person or a related party, then first thing we have to ensure that the transfer pricing documentation is prepared properly and justified. In transfer pricing documentation, there are various methods as well, which we have a look at it in the next slide. Yes, then you have to maintain master file as well as local file. Generally, master file is being maintained at the holding company level. In that, they always maintain all the company profile, organization structure, the enterprise structure, and the business activities what they are carrying out. And the local file should be maintained by all the subsidiary companies in various countries, whereby they will put up all the financial and operational performances and information on the intra-group or intergroup or any intercompany or intra-company transactions. They will put it, and they will try to justify way of benchmarking database. Here you guys are preparing the transfer pricing documentation for your related party? Not mandatory, yeah? So is there any sort of threshold? But I think transfer pricing, they mentioned everywhere in the law that it has to be maintained, like you ask for the salary to pay to owner or shareholder, then you need to have transfer pricing documentation. I hope in public cabinet decision they might come up with some sort of threshold like you guys have. Rental in UAE, it is very, very transparent. It is available on the website by various areas, and you can find out in a particular building what was the last transaction at the price, whichever it is sold, sale price you can find out, rental price you can find out. It is all transparent. But for salaries, yes, it is not there as of now, and I think maybe then, but in Saudi or some other region, it will be there. No, in the once we get that benchmarking database for the transfer pricing documentation. I get your point, but I think there are database available, benchmarking database is available, and generally I was just even inquiring in the market how much it will be costing. So it will be costing roughly 75,000 US dollars, and you can buy those benchmarking database, and then maybe in UAE, in at least in Saudi or maybe in Oman or some benchmarking data will be available. I mean, I know that it is not privately available, but there are various databases from where we have to select and then put it in our transfer pricing documentation that you have taken these numbers from this database and maybe from neighboring countries, some other countries we have to pick up. But yes, let's wait and watch. I mean, it will be interesting to see. Tax losses, as I mentioned you can carry forward it for the indefinite number of years, and 75% of the taxable income is the threshold beyond which you can't, and better you carry forward. This is one of the example, like company A in 2024 has loss of 100, and then 2025 profit 200, and 26 300. So if you look at it now, in 2024 they carry forward 100, and 2025 you have to calculate 75%, which is 150. So you can set off this 100 and carry forward will be nil. And in 2026 there will be a tax on 300. And in example B, company B, if you look at it, there was a loss of 175, and in the year 2025 200. So you calculate 200 into 75%, 150 is the maximum set off you can do, and remaining 25 you can carry forward.
And again in the next 2026 they have a loss 100, so 125. Then in 2026 you will carry forward 125. One thing is anyway, I mean by default, but anyway they have put it in the law that you cannot carry forward the losses which are incurred prior to implementation of the corporate tax law. And also losses incurred from an asset or activity, the income of which is exempt, that you cannot carry forward. Now, if there is a change in the shareholding, like, and at least we have to see that the old shareholders shareholding has not gone below 50%. It has to be minimum like 50% or more, they should continue to hold. Otherwise, in the new, because they consider as a new company then, if the shareholder has changed, and then they will not be able to carry forward. I have taken one example as well. And another thing, once you see this criteria is met, then you have to see another criteria. So if they are conducting the same activity or mostly same activity, same business activity, then it will be allowed. Carry forward, otherwise it will not be allowed. Even if you are meeting the criteria number 1, that is still existing shareholders are holding at least 50%, but they have to ensure that they are conducting the similar business activity, then only they will be able to carry forward the tax losses. This is one of the examples I have taken. In the year 1, there were 2 shareholders, X and Y, 30% and 70%. They were holding in Z and company. Then in year 3, they have sold their shareholding, 40% they sold to A, and but still they are holding more than 50%, total is 60%, so they are holding more than 50%. So they will be able to carry forward the losses from the prior years, and they have to ensure that they are conducting same business activity. Now tax group. Tax group actually, if there are like more than one company under the same parent entity, that we have to ensure that the parent entity is holding more than 95% in each of the subsidiary, then you can form a tax group. But you have to keep in mind that all these entities should be in the mainland. You cannot include any entity either from the free zone or an entity which is exempt. Okay, that is one of the most important point. So if you read it here, a resident parent company, juridical person can form a tax group with one or more other resident subsidiary where all the following conditions are met. So parent company should hold at least 95% of the share capital, voting right and profit rights, and cannot be formed with exempt person and qualifying free zone person, and they have to have same financial year and same accounting standards, then only they can form a tax group. Once you form a tax group, then you have to submit only one tax return for all the companies. So operational efficiency is there, and you can eliminate all the group intergroup or like all the intercompany or intra-company transactions you can remove, and you can consolidate and then arrive at the taxable income and then submit one tax return only. I tell you, I mean, even in UAE, in the UAE corporate tax law, they mentioned that any acceptable financial reporting standard will be okay. They didn't even bother to mention IFRS. It is same, no? At the end of the day, IFRS for SMEs treatment-wise. We have to wait and watch then, I mean, let's see. Okay. Then transfer of tax laws. I mean, if you are not forming a tax group, because in the earlier example I mentioned that parent company and subsidiary company, I was talking about the juridical person, but there might be cases where natural person, an individual is holding 10 entities. Then he cannot form a tax group because he is not a juridical person, he is a natural person. In that case, what you can do, you can rather transfer your tax losses from one entity to another entity if your holding is 75% or more. This is one of the tax relief they have given, that still you can transfer it. But unlike in tax group, you filed only one tax return. Here you have to file 10 tax returns. That you have to file. And the other conditions are same, like it shouldn't be an exempt person or qualifying free zone person. And again, you have to have same financial year as well as same accounting standards that you need to ensure. No, business may be different. No issue. As long as that natural person is holding more than 75% of the shares, then you can transfer. No problem. So this is a kind of tax relief they have given, because he cannot form a tax group. So at least as an individual, he is getting this relief. Withholding tax, I think I already discussed that it is 0%. Foreign tax credit, you can always, whatever foreign tax you have paid, you can get the credit. And withholding tax credit, if you have paid withholding taxes outside your country, then you can get those credit as well. Yeah, so we can get that credit, no, going forward, because these kind of queries we were getting from a lot of companies, particularly for Oman-based entities. I mean, they are deducting withholding tax, as well as Saudi companies, they are also deducting withholding tax. So we were not getting the credit of those. Now we will be able to get it once the corporate tax is implemented. No, everyone has to file the return. No, not withholding tax return. It will be corporate tax return, whereby you will mention that, okay, you paid withholding, this much withholding tax was deducted in Oman or Saudi or any other country, and you take the credit and provide or substantiate with some sort of evidence that you paid. Yeah. But one good thing is, like, it is applicable on all the companies, irrespective. There is no taxable income limit, nothing. They haven't mentioned anything. So it is applicable on all the companies. Forget about the companies, they have even taken all the natural persons in this tax regime. That if you are doing any business, no, you cannot claim, because if you don't have the tax liability at all, then how will you claim? And you cannot claim it next year then. You cannot carry forward the taxes paid in the last year or previous. No, government, UAE government, I mean Federal Tax Authority will not give you the credit for that. Return has to be filed for every single company. No, there is no separate withholding tax return at all. There is nothing sort of, it is very simplified process. You have to submit only once, corporate tax return. It is all self-declaration. As of now, VAT return, what we are filing, I don't know about Oman how it is. In UAE, you just write taxable supplies, 5% VAT, and they accept it. They are not asking for any invoice. It is all self-declaration. So up to you. I mean, you don't declare. At a later date, they will look at your personal bank statement, and then they will see, okay, now then they will catch you and they will actually impose penalties. No, for VAT also, for your information, if they are generating an income of more than 375,000 dirhams per year, even the artist, whoever is coming there and performing, they have to register themselves for VAT purposes, and they have to file the VAT return. No, but they are supplying, no, they are generating income. So there is a taxable supply. They have to pay 5% VAT on that. I mean, it is happening, you are right, practically that's what is happening, but there are big companies who has recognized this one and they are doing it properly. They are advising their artist, please register it here, otherwise there will be a penalty. So all those things will be taken care of, I think. Yeah, now if you look at other key provisions, registration, now they have invited actually few companies for registration by invitation, all big companies, and they have identified few companies for the registration. As of now, there is no registration due date. And they mentioned that even if you register the company at a later date or if you delay it, there will not be any penalty charged for that. This is what they have promised in the beginning. They will not charge any penalty for non-registration. But yes, they will come up with the due date and all. In case of individual, as I mentioned, that they are also under the purview of this tax regime and they have to register, file the tax return, everything they have to do. Free zone persons, we already discussed that if they are qualifying free zone person and if they are generating qualifying income, then it will be 0%, otherwise it will be 9%. So qualifying income and non-qualifying income, again, we are waiting for the cabinet decision to be clarified, I mean, what is qualifying income. And record keeping, you have to keep the records for 7 years as per the UAE Corporate Tax Law. That's they mentioned. And POEM, place of effective management, as you guys are aware, I mean, we discussed in case of PE as well. If somebody is like managing their overseas companies from UAE, then place of effective management is established and they are taking all the strategic decisions from UAE. Then you have to register and you have to pay the taxes because place of effective management is in UAE. And VAT deduction, we already discussed that recoverable VAT input you cannot, and irrecoverable VAT input you can claim as deductible expenditure. This is very important actually. General Anti-Abuse Rule, GAR. In India it is called as General Anti-Avoidance Rule. And India has come up with this GAR rules after 40 years of implementing the income tax. In UAE, they have already come up. Even before the UAE corporate tax law was issued, they already mentioned that GAR is applicable. So now if you are going to make any change in your company structure, like you are in the mainland putting, now closing the company and opening up in free zone or vice versa, or if you are changing the salary of your shareholder, partner or yourself, all those, and if you, suppose if you are trying to change your financial year in order to postpone the implementation of the corporate tax law, then you have to justify why you are doing it. And if it is not justifiable, then Federal Tax Authority either might roll back whatever changes you have done or recharacterize the same. And they can penalize or for whatever you guys are doing if it is not solid, substantiated or rationalized. So this GAR, now this GAR rule is very, very important, and as a result of that, now everybody is coming to consultant, all the companies, they are approaching the consultants that what to do now. Yes, you can do it. I feel, I mean, because a lot of companies now, they are trying to close in the mainland and opening up the company in the free zone if they are dealing in the free zone or outside the country. So people are doing it, but yes, there is rational decision, then you take it and go forward. I think there shouldn't be any issue as such. So the way forward is now, I mean, yes, initially we have to do the review because you know that in this region or particularly in UAE, people are not maintaining the books of accounts on accrual method or as per the IFRS, and there are a lot many transactions happening within the related party or connected persons which we have to analyze and guide them. So there are many things which is happening, not happening in compliance with the companies law as well. There is companies law, amended companies law which came into effect on 2nd of January 2022. In that actually they have mentioned for the public joint stock company there is a limit, threshold limit for the director's remuneration and fees as well, which will be applicable anyway for all the companies post 2nd January 2022. And that law or that particular article 171 is applicable even for LLCs as well. So that threshold, I think we can also use it when it comes to corporate tax law. Yes, then after that, we have to, once the regulation is out, now cabinet decisions are coming, then we need to impact, or we need to look at the impact assessment, what is happening, and we need to, if we have to do any sort of tax planning by way of changing the enterprise structure or company structure and any other transaction, then we need to look into it and take an action. And before financial year starts, then yes, we have to be ready with the system as well as with the policies, procedures in order to substantiate any of the claim. And after the start of the fiscal year, financial year, then ongoing monitoring, I feel that on monthly basis, we should, as a consultant, look at all the transactions, what is happening, whether it is allowed, disallowed, and then we need to advise the client properly. And transfer pricing is one of the most important, I think, documentation which we need to have. And it has to be started from now, otherwise we don't have much time left out now. I think I am done, unless you have any other question which we can take it up. I know you guys are already pro because, one corporate tax is already there. Since when it was implemented? 81. So you guys are anyway professional.
Thank you very much.
Thank you very much, guys. And
And now we are open for Q&A. For the benefit of Soha team, whoever is asking question, please use the mic. We'll pass the mic to them.
Good evening.
Hi, good
See,
evening.
when you spoke about transfer of tax losses, can the loss be transferred to associates and sister concerns and JVs?
See, as of now, in the law, it is mentioned very clearly that if any natural person is holding more than 75% in any of the entity, then you can transfer.
Okay.
So that is the main
So
criteria.
it can be like, I can tell you one situation
Yeah, please.
where the subsidiary is making profit but the holding company is making loss. So in this case, is the
Yes, because in the holding company as well as if the subsidiary company,
the
the
owners are
natural
the same.
natural person is holding more than 75%, then it will be allowed.
And another thing, just it's something like 5 years.
But
down
if
the
you are
line.
talking about holding in subsidiary company, then I would suggest that you can go in the, you can create a tax group. Because if you are holding company, suppose is holding 100% shares of the subsidiary company, then you can form a tax group rather than going for that another tax loss relief. And because you are holding more than 95%, you can set off the losses. There is no problem. And that is one of the actually added advantage. If we are having any startup in the group, then you can always, you will have always loss situation. So create a tax group of all these companies, wherever like startup companies or capital intensive company, where you are really in the beginning incurring huge losses, you can recover from another company's profit.
The other question is, this is something 3 years or 5 years down the line. Can there be a scenario, say 3 to 5 years down the line, that there is a uniformity in direct taxes by all GCC countries, like strictly following IFRS standards, standards on auditing, standards on internal auditing, etc., like that?
No, as of now also I tell you, I mean in UAE, it is generally not mentioned anywhere, but still the practice is IFRS. Most of the companies, like big companies, if you look at it, MNCs, all the companies, they are following up IFRS, International Financial Reporting Standards, across. So, and in future, I think GCC wide, they should come up with some sort of initiative now, because the IFRS has to be implemented in all the companies, I mean across GCC, then taxes are coming up. So if there is any deviation, then it will be a problem, and people might take tax advantage, by having few cross-border transactions across GCC. So I hope in future definitely there might be some sort of introductions for these kind of things. Yeah. UAE commercial companies law and DFC, they have already mentioned very clearly that IFRS has to be implemented. Yes. But like here in UAE corporate tax law, just one thing, for all the UAE mainland entities, they didn't mention that audit is mandatory. But for free zone entities, audit is mandatory. For UAE mainland entity, they didn't mention about the mandatory audit. Yeah, it is again self-declaration. So this is what we are surprised as of now. So we are waiting for the cabinet decision. Because for the UAE mainland entity, yes, when you look at the memorandum of associations MOA, then it is mentioned actually. As per the company law, it is mandatory, but still it is not being followed in practice. Yeah.
The concessions that minimum tax rate should be 15%.
Yes, Pillar 2 of OECD, that will be implemented. That will be implemented very soon, Pillar 2 of OECD. So if your gross turnover at the group level, gross turnover is more than 750 million euro, then 15% minimum tax rate will be applicable. And but I think in the phase 2 they will be coming up in UAE. But yes, it will be implemented. So then there will be two types of rates, 9% and 15% for multinational enterprises.
I didn't get this 375K threshold. It's standard deduction or?
No, this is a kind of relief like the slab rate from 0 to 375,000. It will be 0%. And
Okay.
above 375,000 taxable profit, it will be 9% tax rate flat.
And is there any advance tax payable?
No, sir, there is no advance tax, nothing. It is very straightforward. Once your financial year is over on 30th of December, then you have 9 months. So by 30th of September, you have to submit your corporate tax return.
In Saudi, for
Yeah.
foreign companies, I think they charge 20% on corporate tax. And even if the current year is a loss, they have to pay the advance tax as per the previous year profits.
Yeah, no, this
Whether
kind
it
of,
is, right?
no, it is very simplified version here as of now, as we speak.
Okay, they have to file return and take the refund in the current year.
No, I think here it's very straightforward. Only one corporate tax return, no withholding tax, nothing. Simplified return will be there on the online.
Let's say there are some individuals who are non-resident who are in Oman, and they are even they invested in let's say in Dubai, in real estate, and so they are getting the income from basically a real estate which is based in Dubai. So they are required to register and then pay the or file the return.
See, as I mentioned you, I mean, still the definition of business, what individual persons or natural persons are doing, that is not very clear from the UAE corporate tax law. But I feel like if you are having 2, 3, 4 properties in Dubai and getting rental income out of that, I think it shouldn't be taxable. But yes, if you are having like 10, 20 properties, then it's a kind of business. And as I mentioned you that it will be considered as UAE sourced income. If you are having any asset in the UAE, then you have to pay the taxes, you have to register yourself, and better you pay the taxes. I think it, but yes, wait for the cabinet decision.
And also they didn't they are not going to capitalize this capital gain thing.
No, dividend and capital gain from the domestic company, it is exempt income. Dividend and capital gain from the foreign juridical person, if you are holding more than 5% shares in those foreign companies, then it is exempt.
We have a question from Sohar team. There is no personal taxation in UAE. It's only business taxation. Can you
Right.
clarify how to distinguish?
Now, as I mentioned you, corporate tax will be applicable on businesses, companies, and individuals, natural persons, if they are conducting any business activity. Then 9% corporate tax will be there. But as far as the individuals are concerned, individual income tax is not there at all. So if you are generating any salary or managerial remuneration or any other thing, then it will be tax free still, because individuals are still not under the purview of income tax. It is the tax on the corporation and businesses. Yeah. No, there is a difference between remuneration and sitting fees. So remuneration is generally by way of labor contract. Non-executive director, you are a non-executive director who is not an employee. So for that, in the Commercial Companies Law 2022, which is 2021, which has recently been released, in that they have mentioned that fees and remuneration cannot exceed more than 10% of the net profit. In case of profit, if their company is generating profit, if the company is not generating profit or they are into loss or generating inadequate profit, then in that case, maximum they have put a threshold of 200,000 dirhams. That will be your, no, that will be your individual income, no. That will not be considered as a business. No, I don't think so. That is your individual income only. Yeah.
In continuation of the same question as my brother asked,
Yeah.
that even a small businessman, he's doing very small business, for example, even he has to take the registration. He's an individual only, natural person.
No, natural person, again, I mean, up to you. I mean, if you think that you are doing a business and you are not registered yourself, I would request you to register as a company and then do the business. If you are not registering, although you know better, I mean, like you are giving the private tuition now,
Yes.
you can always hide if you want to hide. But then how long you will be, I mean,
No,
if it is a small income here and there, sir, it
Private
is all,
tuition can be
sir,
hide.
sir, it is all self-declaration.
For example, for a tea stall,
Hmm.
tea stall in UAE,
Yeah.
and then he has to get registration even. Means
Everyone has to register.
everyone has to.
100%. Yeah. And if he is doing, see, I tell you, if you are doing any business activity without a license, then it is illegal actually. Some time or other time you will be catched and there will be a penalty. Now one classic example is in UAE, earlier like one individual was giving loan to another individual, one company was giving loan to another company or to individual, that was all allowed. Nowadays banks are closing your accounts if you are doing any loan activity because they say that the financing activity is belonging to only banks and the non-banking financial institutions or exchange houses. You are not supposed to do any loaning activity in your personal capacity. And even as a company, like general trading company is giving loan to another general trading company, they can only give the loan only in case of if this is a group company. Like there is a big group under which there are like 100 entities or 50 entities and then they are having the pool of funds at the holding company level and they are helping the subsidiaries, that is fine. But if it is unrelated party altogether and you are giving a loan, so that is not legally allowed in UAE. Nowadays banks are hammering and they are asking you to sign the declaration that by okay, you have given the loan, but now you cannot take it back from this company. If you take it back, I will close your account. This is the declaration they are asking nowadays. So yes, I mean, going forward, all the activities, business activities, if you are doing in a personal capacity, better you take a license and then do it. Yeah. Yeah. Yes. Yeah. Has to be registered and then in that case anyway you have to. And there is no threshold. They have mentioned very clearly, they categorically in one of the two conferences actually they have organized Ministry of Finance and FTA jointly and they made it clearly all the companies have to register. And if you look at it, it is in their interest. Suppose you are starting a company and still you didn't like have 375,000 dirham as taxable income, but in the beginning you are generating losses. So it is better you register. So all the losses you can set it off when you generate profit. So it's in your own interest.
That 50% shareholding for eligible carry forward losses, if there is change in if the company is sold some other companies like merger or amalgamation, there will be a change, complete ownership, no sir?
No, then you cannot carry forward. Then you cannot carry forward
That
for
we
sure.
lost it.
You have to ensure that minimum 50% of the shares are held by the old shareholders, existing shareholders. Otherwise, you can't. And once you achieve that, okay, in the new company, existing or old shareholders are still holding more than 50%, then the second condition is still they are doing the same business activity. Then only you will be able to carry forward, otherwise not. Yes, they mentioned mostly similar or same business activity. So if you are doing it mainly that activity, main activity, then fine. You might have some ancillary activities.
One second.
Sorry? No, I got your point, but see, you have to see. Now you are rather, why companies are being bought by another person? Because they are looking at the, generally that the bank account is there and business already is set. But now the shareholding has changed completely. Then it doesn't make any sense to carry forward the loss and other party will take the advantage of it. So it is not, that loss was not generated during his tenureship. So that is the logic. Public joint stock company, I agree with you that shareholding is getting changed. But in that case also then it has to be seen. It has to be seen because majority of the shareholding, if you look at it, in UAE listed companies, whether on DFM or Abu Dhabi Exchange, all those companies are majority held by the promoters. 15-20% is in the market, 80% is held by the families. Yeah. No, you have to look at during that particular year when you are filing the corporate tax return, that time you have to see the situation. And if they found after 5 years, then yes, there will be penalty and yeah, you have to see in that, you have the 9 months anyway to file the corporate tax return, but you have to see during the year what is happening. Yes. Yes. No, this problem is already there even in VAT. People are selling the companies and then they are leaving the country. The person who is there, he will be caught for any sort of penalty and everything. That company will be responsible, as he mentioned that company is a legal entity. At the end of the day, they will catch. But this particular article, they have brought it. You can't help it. And that's the reason what in UAE, whenever we are helping any client to buy an existing entity, we always try to get the full KYC of the guy who is selling. Even if he's an Indian or all the KYC, we take it. And then we sign one agreement as well, that indemnification, some sort of agreement, that in case of any VAT penalty or anything, then that will be, reimbursed by the original seller or transferor. These kind of issues are there, and that's the reason nowadays people are not buying any, they are all trying to avoid it unless they have any other malpractice in the mind and they want to do some backdated contract, then only they buy. Otherwise, people are really reluctant nowadays.
We have a question from Sohar team.
Yeah.
In case of group registration, is there any threshold exemption? Say 10 companies in a group, what will be exemption limit? 375,000 or 3.7 million?
No, because in case of tax group, this is a good question. In case of tax group, if you are having 10 entities whereby you have more than 90%, parent companies holding more than 90%, and you clubbed all 10 in one group, tax group, then it will be one single return, means 375,000 relief will be only for one company, one group as such. So you have to do always tax planning accordingly, whether you really need to create the tax group or not.
But the individual registration comes first or the group directly comes? Like earlier they all allowed to go for individual registration first and then they clubbed it.
No, no, it will be from the day one when they open the window. They already open the window for few selected big groups and they are doing it. So at the same time you can do it.
Okay.
You don't have to wait.
We'll take the last question. Wait. Use the mic so our team can listen to you.
If there is a holding company and it has got two subsidiaries, one of them is making profit and the other is making losses,
Yeah.
it can be set off, right? You said.
Yeah. I mean, you form the tax group if you are having more than 95% shareholding.
What happens if the loss-making company has closed down during a tax year? Can that accumulated loss be transferred to the other company?
Okay, that company is already closed. Then in that case, we have to again check. I mean, this point I am not very clear, but I feel if it is activate at least in the maybe you closed it on 1st of July during the half year, then I think it should be allowed. Technically speaking, it should be allowed.
Though we said last question, there's a continuation to this question from one of our friend here. He said, is partial grouping allowed? Like a group has 5 entities, they want to group.
You can do that. You can do that. There is no problem as such.
You have one more?
In case of a deceased person, he shares a transfer to his legal heirs. Then what happens? The ownership changes. Under that circumstances, loss carry forward is allowed or not allowed?
So this is a very technical question you asked for, but I think technically his legal heirs are still the same. So I feel it is same. I mean, because this is a very tricky situation you put it, but I feel it is the shareholding is same. It does because at the end of the day his legal heirs are legal heirs according to the will. So it will be same company. It will not be a different company. And it should be allowed. And there is no sale as well. This is by virtue of legal heirship. Thank you.
All right, if there are no more questions, we close the question and answer session. Thank you very much, CA Harikishan Rankawat. As your name says, it is full of knowledge and it was a great to hear you. May I please request Chairman Mr. Sajeev to please felicitate CA Harikishan Rankawat.
Thank you very much, guys. If you have any other question, I'm available anytime, 24/7. Whenever you want to contact me, please. And I will share my presentation to the team, who in turn will share with you. Let's keep in touch. Thank you very much. Have a nice evening.
Thank you very much. May I please request CA Jim to formally thank the crowd.
Thank you, Bala. Good evening to all. Normally, UAE used to make the things very simple, but looking at the tax law, it seems like it is not that simple. But Harikishan ji, thank you very much. You made it very simple, very interesting session. We all enjoyed the session. Thanks for your efforts. And now you are the vice chairman. We hope to see you as chairman in the next visit. All the best to you. Thanks to FinPro for supporting this event. Thanks to CBFS, our sponsors, all our supporters, corporate sponsors. Sohar team, thanks for joining. Thanks to CP team for conducting all these things, connecting all these things. Hotel team, photography team, thank you very much. Thanks to all the members for joining. Enjoy the dinner. Good night.